Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hey everyone, welcome to today's top stock pick of the week. My name's Andrew Rocco. I'm a stock strategist here at Zacks Investment Research. I'm also the manager of the Tech Innovators portfolio, and I'll be taking you through my top stock today. And today's top stock pick is Li Auto Inc., ticker symbol LI. Li Auto is an innovator in energy vehicles, so it's a Chinese company. The company designs, develops, manufactures, and sells premium smart electric SUVs, only SUVs. Li Auto Inc. is based in Beijing, China, and it currently has a Zacks rank of number 1, strong buy, which puts it in the top 5% of the more than 4,000 stocks that we rank based on our earnings estimate factors. So moving to the next slide, Li Auto is an EV pioneer looking to successfully commercialize extended range electric vehicles in China. The company started volume production in November 2019. Its model lineup includes Li L9, a 6-seat flagship family SUV, the L8 and the L1, both of which are 6-seat premium family SUVs, and the L7, a 5-seat flagship family SUV. The company leverages technology to create value for its users. It concentrates its in-house development efforts on its proprietary range extension system, next-generation electric vehicle technology, and smart vehicle solutions while expanding its product line. So what's intriguing to me about Li Auto is that even though they started production just in 2019, which is a super short time for an EV maker, they're already profitable by 2021 and have been profitable ever since. So anyone who studies the auto market and specifically the EV market knows that manufacturing these type of cars is not easy, and profitability is very difficult to achieve. So the fact that they're already profitable in such a short time, speaks volumes for the company. So Li Auto is a member of the Zacks Automotive Foreign Industry. The industry is ranked 37 out of the 250 industries tracked by Zacks, making it a top 5 industry group. Remember that the industry group is an important factor in determining an individual stock's potential. Our in-house studies have shown that a stock's price movement can be attributed to a stock's industry group by as much as 50%. So 50% of how much the stock moves is solely based on that industry group. And the top 50% of industry groups tend to outperform by a factor of more than 2 to 1. So we want to focus on the top industry groups and then the top stocks within those industry groups. And Li is the top ranked stock in this industry group. And one thing that stands out to me is their projected sales growth. So you can see Li Auto is projected to grow at a rapid clip of 131%. If you compare that to like their biggest competitor, NIO, they're only growing at 66%. The S&P is growing at 4.7%, and the industry is 8.7%. So really healthy sales projections for Li Auto. Let's move on to the recent revision history. So when trying to determine the future direction of a stock's price move, you need to look at what a company will earn in the future. This is why earnings expectations or earnings estimates are so important. And it's the change in the earnings estimates, the earnings estimate revisions, that have proven to be the most important factor. So Li Auto's recent revision history paints a rosy picture. Analysts have become more bullish in the past month and believe the company will grow at a healthy rate of 78% this year and 250% next year. So that's about as good as it gets for earnings projection. So we've talked about future earnings expectations, but the previous earnings history tells us how much we can trust those lofty earnings expectations, in my opinion. And outside of the first quarter as a public company, Li has surprised to the upside on every single quarter as a public company. And they've not only beaten, they've beaten by a wide range. So on average, by about 86%, they've beat earnings to the upside. So when I also look at the chart, the 2024 expectations, which are the brown line, that just shows the potential for this company. You can see in 2024, analysts are expecting that dramatic spike in earnings. Now, beyond the fundamentals, there's nothing like some good old government incentives to drive earnings. And in 2009, the Chinese government introduced subsidies to help the EV industry in the form of a 10% purchase tax exemption. And those exemptions were set to expire this year. However, earlier this week, all the Chinese EV makers jumped on news that the government is considering extending those incentives. So if that's the case, it's obviously going to be a major catalyst for shares of LI. And even though LI went public in 2020 and the stock can be volatile, obviously it's a Chinese EV maker, it's held up relatively well from a price and volume perspective. So the Chinese economy has been very weak, especially on the real estate side, but overall the Chinese economy has been weak after the stringent COVID lockdowns. But despite that, LI has outperformed. So just to put things into perspective, over the past 2 years, NEO is down 82%, and compare that to LI, which is up 12.9% over that same time period. So even if the Chinese economy simply stabilizes, I expect shares of LI to run, but if it has a recovery, LI has multi-bag potential over the next, let's say, 3 to 5 years, which would obviously be great as an investor. Now let's move on to the long-term technical picture here. One of the most intriguing things about LI is its price and volume action. Right now, you're looking at a quarterly chart. So as you can see by the long wicks on the candles on the chart, every time it's tested those lows, it's found buyers in a dramatic fashion. So just another clue that despite the macro pressures, LI is finding buyers and it has potential to be a leader if those macro pressures kind of dissipate. Also, I like the fact that the company came public recently. It's almost like it's fresh merchandise and it hasn't been on the market too long, so it might generate some investor interest as far as that goes. Now on to the short-term technicals. You're looking at a daily chart of LI here. And on a short-term perspective, shares are building a bullish flag pattern. You can see it ran up and then has just gone sideways. But one thing I noticed beyond the positive price action is the bullish volume action at the bottom of the chart. You can see the volume spikes on the upside days. In my mind, those are signs of strong demand in the stock. And just to summarize, LI Auto is an intriguing stock on several levels. Earlier this week, the company announced a surge in delivery numbers, reporting a year-over-year increase of 146% to 28,000 vehicles. So not bad. Remember, they just started doing this in 2019. This achievement surpassed previous month's delivery record of 25,000 units, marking the third time Li Auto has exceeded the 20,000 mark in monthly deliveries. As we mentioned earlier, the company is outperforming its Chinese counterparts from both a sales and relative price perspective, which is another positive. And finally, looking forward, the company has very strong analyst estimates, which earn it that Zacks ranked #1. And it has potential catalysts such as the extension of the EV tax credits in China. Okay, everyone, so just to summarize, my top stock of the week is LI Auto, ticker symbol LI. And I'm going to pass it on over to my colleague, Ben Rains, who will cover our next top stock of the week. Thank you very much, everyone.
Thanks, Andrew, and hello, everybody. Ben Rains here. Today I'm looking at Graphic Packaging Holding Company, which trades in the ticker GPK. The basic pitch to investors is that graphic packaging stock offers a wonderful combination of really stellar value, stable growth, dividends, and a market-crushing performance over the past 15 years and the past 12 months. And GPK stock still trades for around $25 per share, though it's inched up above that level. So now let's dive a little bit deeper. Graphic packaging is far from flashy, yet its portfolio of paper packaging products are essential cogs in the economy, serving clients in industries such as food, beverages, food services, to personal care, household products, pet care, and beyond. The paper-based packaging solutions include cartons, cooking solutions, food service containers, cups, and much more. The Atlanta, Georgia headquartered firm also expanded its reach when it acquired AR Packaging back in November of 2021. That helped it expand geographically because AR is one of Europe's leading packaging companies. So now I'm going to go share my screen here so you can see we're on the Graphic Packaging Holding Company ticker page. You can see it lands a Zacks rank #1 strong buy at the moment, and that was helped by it crushing our Q1 earnings estimates in early May. And this is part of a long-term string of beats, and then also lots of positive upward earnings revisions. We can see just the steady climb since the beginning of 2021 with just all these upwards revisions, which is really impressive. And now we're going to go ahead and take a look at some of the growth outlook for the company. So we're calling for about 6% growth this year, and then another 2.5% growth in the top line next year. And we'll get to that because that comes on top of really impressive top line growth over the last several years. And then we're calling for another 30% growth on the bottom line, and then 2% growth following up that big 30% growth this year. And then as I said, we see these upward earnings revisions, and we can see that it crushed earnings last quarter. So that first quarter results. And then I'm going to go quickly to this revenue growth because it shows that, they did booming growth last year, 9% growth the year before, 7% growth before that. So really steady growth on the top line, and then also some really impressive earnings growth recently. And you can see that they're going to continue to do that as well. So that's a great sign to see. And now we'll also go and look at some price performance data because, as I mentioned up top, the stock has outperformed the market over the last year and over the last 15 years. So we can see easily outpacing the S&P 500 up about 13% over the last year. And then if we look long term, we can go out to 15 years. We can see that GPK is up almost 1,200% compared to the S&P 500. It's 250% climb. This also outpaces its econ sector, which is the industrial products market. But we'll go back to the S&P just to give people a sense. And now we'll go and look at some technical levels because if anyone's focused on those, we can see that if we go over the last year, we can see that GPK now has spiked right back above that 50-day moving average. So after a little bit of a downturn, maybe some profit taking following earnings, spiking right back up, trying to get back towards new highs. So we can see that 50-day has been a nice level that traders have been holding, which is always a positive sign. And then we're going to close out these views by looking at some of the valuation metrics because GPK, along with that huge outperformance of the benchmark over the last 15 years and over the last year, we can see that if you look at its 10-year valuation chart, it's really rather impressive. It's trading essentially at near its lowest times ever over the last 10 years at 8.35, so 8.4 times 4 12-month earnings, which compares to the S&P 500's about 19 times, well below its own highs, well below its own median of about 15 times over the last 10 years. And if you compare it just to, say, its industry, it's also looking solid as well, considering its outperformance. So it's trading at a big discount to its industry, even though you can see that it's outperformed its industry really well over the last 10 years. So along with its value, you get this outperformance as well. Meanwhile, Wall Street's really high in the stock with 8 of the 10 brokerage recommendations that Zacks has coming in at strong buys alongside 1 more buy and 1 hold. So that's no sells out of the 10 brokerage recommendations that we have. The company also pays a dividend that's yielding 1.6% at the moment, which is really solid considering its performance and its low 15% payout ratio. The company is also expanding its production efforts amid growing demand. And overall, it operates a really boring, essential business that's poised for steady long-term expansion. And it appears to be a great stock for the current economy and the market uncertainty and economic uncertainty and for years to come. And in full disclosure, I do own graphic packaging in my own personal portfolio. So that does it for me in this episode of Top Stock Picks. Make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more.